Look, you know what? There's a code to having a successful real estate career. There's also a code to having successful real estate transactions. That's what we teach you here. The code, the Realtor Code. I'm Mark McInerney, President and CEO of CodeMark Financial. Welcome to Mortgage Money Genius. Today we're going to teach you non-QM loans. Sit back, relax. 3, 2, 1. Off we go.
I just wanna be your superstar, 'cause it's not where you're from, it's where you are.
So look, we've been taking you through the entire process of pre-qual to pre-approve, learning about the different traditional loans such as conventional, FHA, VA, USDA, jumbo loans. You got to see my kids, you got to see my wife. Hey, we give everybody an opportunity to get on camera here. Note to self, because if you call and you want to come in here, I might throw you on camera too. But we're now talking about non-QM loans, right? Because those other loans that I was just mentioning to you are QM loans. And I told you in the last episode, like the difference is QM just stands for qualified mortgage. Non-QM would be basically non-qualified mortgage. And what deems a qualified mortgage is the guidelines that Fannie Mae and Freddie Mac place on the very traditional style loans, the traditional style loans that you're probably most accustomed to receiving offers with, right? The conventional, the FHA, the VA, and if you're selling some of the bigger homes and rural homes, jumbo loans and USDA loans. But it is becoming more increasingly popular that non-QM loans are becoming a vehicle for, I'll say today, but also tomorrow's home buyer. Why? So many people now are entrepreneurs. I mean, you're an entrepreneur. Yeah, sure, you say you're a real estate agent, but you're self-employed. You work for yourself. I'm an entrepreneur. I run a mortgage company, but it's my business. That is what most people are looking for anyway. Actually, you probably have this too, right? You got clients, you got friends that are all like, man, I'd love to get into real estate. Or maybe they have some skill set that they're interested in trying to sell as more of like being, a business of their own. This type of loan would help those types of buyers. And because people are looking to find money outside of the box, and the box being the whole traditional lending style of things, well, this is going to be the way. This is going to be the way of tomorrow and tomorrow's lending, to just offer more options than just the QM stuff. So just a quick recap. Last week we talked about non-QM are offering stated income loans, which is we're going to dive in today. No or low doc loans. We'll talk about that next week. Investment loans, like for investment properties, having more investment properties other than just say, the standard handful up to maybe 10 that traditional lending, QM, will allow. Also fix and flips, that's also increasingly popular now too. Everybody's getting into the real estate market for the purpose of trying to expand their investment portfolio. Not everybody wants to have their money tied up inside of Wall Street. So fix and flips would be obviously a good option as well. And then we've got 4 national programs. Look, here specifically in Houston, but I'll say really anywhere in the country, going back to that same philosophy that I was telling you that entrepreneurs are kind of becoming a many and a plenty. Well, we've got a lot of people coming to this country, and there's a lot of American-based companies that are employing people that come from other countries. These people will want to qualify for home ownership here too, especially if it is unattainable in their home countries. All right, so let's get after this. Let's hone in on stated income. So stated income, well, what is stated income? Well, stated income is merely stating what your income is, right? Yeah, you're probably thinking, Mark, I knew that. I know you do. But here's what you need to know about it. So let's just say you, for example, right? You might make $100,000 a year inside of selling real estate. But I'm willing to bet you don't pay taxes on $100,000 a year. And don't worry, I'm not calling up Uncle Sam. That's the benefit of being self-employed, is to be able to take tax deductions. Because at the end of the day, that is what even our government encourages. It's like, hey, work for yourself, employ others, and here are the tax benefits because of being the person that, well, heavy is the head that wears the crown. But if you're going to be self-employed, you might want to be able to try to afford what income you actually really make, right? If you make $100,000 and you pay taxes on 50, if you go back to previous episodes, we talked about using the gross multiplier of 3 to suggest what one could qualify for. Well, making $50,000 a year might afford only somebody, $150,000 price point versus making $100,000 a year. Well, it's twice that amount. A stated income would go based off of that, the stated income. Now, they don't take into account, obviously, all of the tax write-offs and tax deductions, because what they'll look for in a lot of cases is 24 months bank statements. Because how does that justify the income? Well, unless you're stashing the money in a shoebox or a mason jar, you're going to be having money coming in somewhere. So it's going to go into a bank account. And inside the bank account, when they get 24 months worth of bank statements, they can clearly see the income that is being generated by the company on a monthly basis. Why 24 months? Well, hey, depending on how new you are inside of this game and any other sales job that you might have had before this, it takes some time to build up a bit of a business when you are self-employed. Usually the first year is kind of just figuring things out. In a lot of cases, it's kind of like the make or break year. But if you make it, because you will, but if you make it, well, then that next year is like, all right, I got my footing underneath me, and I'm ready kind of to start rolling and start making money. That first year, you've started acquiring some clients, the referrals start coming in, voila. Now you've got 2 years of proof. And the proof that the underwriting companies or the underwriting teams of the lending companies are going to be looking for is, well, how did he do his first year? And how did she do her second year? And they kind of take a combination of the two. Now, with the 24-month bank statements, it allows them to see kind of what that rolling average is, okay? Another thing that is, and these are going to be, kind of good in a lot of different cases as well. A lot of these lenders in the non-QM aren't too concerned with BKs, bankruptcies, or even foreclosures. Because again, entrepreneurs are risk takers. And entrepreneurs, sometimes they got to cut their losses. And again, thank God for this country that not everybody is associated with the mob. That if you don't pay them back or you don't make good on your mortgage, that they're not coming to kneecap you. It's just credit. Now, not to say that it should be considered and thought of that way, but there is a tremendous amount of forgiveness inside of non-QM loans for those that might have had to file a bankruptcy and or also a foreclosure. So take a quick look at this, and this is the basis of what is kind of most important here. One last thing to add here is some of these guys will even go down to a 550 credit score. And why is that important? Well, look, if any of these came into play, if there was a bankruptcy, that's going to hurt somebody on their credit. If there's a foreclosure, that also is going to hurt somebody on their credit. So this does not, though, darn the person, if you will, to purgatory of not being able to buy a house, especially if they've got some strength up there in the income. Take a minute there. I'll be right back. Look, we are fast approaching the change of what's going to be probably the largest change that has ever taken place inside of the real estate industry. You see it. You know this. Why not also change and evolve rather than change and die, as they say, or not evolve and die? Because the reality is your client, the clients of tomorrow, are looking to you still to help assist them with this incredibly emotional commodity that is a home. And you are the tip of that spear. You get to deliver dreams on a daily basis and make dreams come true for these families to be able to afford the home. Imagine how much of a badass you would be if you also knew the money side of it. Because you know as well as I do, it starts with the pre-approval and it ends with the clear to close. And the mortgage is the piece that glues both of those together. Stay tuned. Do me a favor, would you? Like, comment, and share. And keep in here, okay? Because we got so much more to cover. And I want to make you a Jedi, or better yet, a mortgage money genius. I'm Art McInerney, President and CEO of CodeMark Financial. Thanks for joining.